Hey there, Guaranteed Retirement Guy, and today I'm going to talk to you about what is a non-qualified annuity. So what are non-qualified annuities? Well, they're certainly not qualified accounts. Qualified accounts are IRAs, 401ks, 403bs, anything that goes into a traditional IRA or maybe even a Roth IRA. Those are all qualified accounts. And really, they're just called qualified accounts because they're subject to the rules and restrictions of that IRS tax code. Okay, that's what makes it a qualified account. Okay, for non-qualified account, it's just anything other than that. So if you've got cash in a bank account, maybe you got cash in CDs and you wanna cash it out, put it into an annuity, you can do that. If you've got money sitting in your brokerage account, maybe your stocks, you want to liquidate those and put those into an annuity, that would be all non-qualified funds. So all that means is that you're not subject to any restrictions like you are from an IRA or 401k. So non-qualified is great. So here's what it looks like. If you take non-qualified money from, let's say, a bank account, and you put that inside of an annuity, okay, the difference is, versus a qualified account, is when you start taking that money out, the insurance company, what they're going to do is they're actually going to charge you, they're going to take out taxes, whatever your tax bracket is, out of whatever earnings that you made. So let's say you put $500,000 in. This is all non-qualified money. So $500,000 from the bank or from a brokerage account. And let's say you let that sit and grow for 5 years and it grows to $600,000. And then let's say the income, the guaranteed income at that point is $50,000 a year, guaranteed for the rest of your life, whether it be 30, 40, or 50 years, okay? You're getting that $50,000 a year regardless. Okay, so here's what's gonna happen. You already have the $500,000 that you put in, and you got the $100,000 of earnings over that 5 years. Remember, you've got $600,000 sitting in there. So what happens is you take that income out. So the first 2 years, you're getting taxed fully on that $50,000 because they want to tax those earnings first. Once you get taxed on that, the 2 years have gone by, you've taken out about $100,000 in guaranteed income. Now, for the next 10 years, you're taking out $50,000 out a year. And again, they're not going to tax you at all because you're depleting your original principal, which of course was already taxed beforehand. So during those 10 years, it's completely tax-free. So the full $50,000 comes out every single year. It's all tax-free. Now at the end of that 10 years, now you've taken income for 12 years total. You've taken out $600,000 in income. But remember, you're still living and you're going to be living and kicking for the next 20, 30 years. So you're going to continue to take $50,000 out every single year. Now, at this point, it's fully taxable because at that point, it's just extra money that you've earned or extra benefit. And so even though you've used up all your principal, you used up all your earnings, the income is contractual, it is guaranteed. Now, this is a very simple illustration. It could take you longer to get through that because you're going to be earning money on that money that you're taking out during the time that you're taking out. So your account balance is not going to run out in 12 years. It'll probably run out in 20 years. But that's kind of how they do it. The IRS wants its money off of the interest that you earn first. And then, of course, the principal that you take out afterwards is fully tax-free. And then, of course, every benefit, every $50,000 chunk that you get after that, of course, is coming straight from the insurance company. And that is fully taxed at whatever the tax rates are. So if you want to compare that to a qualified account, let's say all your money's sitting in an IRA, well, it's subject to restrictions like you can't take it out till you're 59 and a half or you get that 10% charge, right? But the other thing is it's been tax deferred the whole time, which means you take that $50,000 out, it is taxable for the rest of your life. It doesn't matter how long you take $50,000 out a year. It is taxable. It doesn't matter if the account runs out. It is taxable because it's in an IRA. And an IRA stipulates that all money that comes out, no matter how long, is always taxable because it's been tax deferred the whole time. Okay, so the only difference is you're taking money from an IRA or a 401k and you're putting it into another IRA, except it has an annuity contract that's guaranteeing you income forever. And so that's the difference, except it's just taxed every year after that because it's in a qualified account. So that's kind of the difference between a qualified and a non-qualified. They're both great. The difference is, you're getting guaranteed income from both of them. The difference is just how you're taxed when it's coming out. Okay, so I hope that helps. If you want to learn more and you want me to kind of go over some numbers, maybe you're married, maybe you're looking at, you want some guaranteed income for you, but also your spouse. You want to make sure that they don't ever run out. And maybe you have a combination of qualified and non-qualified accounts, and you want to maybe have an annuity for each one of them, and maybe you just want to do partial amounts. We can look at that. We can look at different strategies as far as turning on income from one right now and maybe an income from another later on. And there's different payouts for those, and they work differently in different states, and it's really up to you what you want to do. But I am happy to get on a call with you, and I'll just show you everything. I'll show you everything, and we'll narrow it down to the very best ones, highest income, and then we'll go from there. If you like what you see, I can help you set it up. And if not, no big deal either. I'll send you a free report and answer any questions that you have. I won't try to sell you anything, just happy to help. So go to the comments section or go to the description of this video. You'll see a link to my calendar, or you'll see a link to another video where you can learn a little bit more, and you can still book a call there as well. So anyways, it's about 30 minutes long. And we'll just get to know each other, and I'll provide you a tremendous amount of value, and I'm not going to try to sell anything. So happy to help. Thanks again for watching. We'll see you on the next video.